when I think of derivatives, I think of the whole housing crisis, the toxic
Yeah,
assets,
yeah.
that back in, which basically kind of is what indirectly birthed Bitcoin, right? So let's try and flesh out a little bit. So what potentially could be the negative side to this whole asset class?
Yeah, so I think you have to take it very seriously. This is not like a spot market in Bitcoin where you just kind of buy and hold. No, you have to actually understand and keep up with the market trends. It's very important you do that.
Mm-hmm.
So if you get in, don't kind of be like half-assed. You're in or you're not. Because you have to constantly measure your risk, constantly look at the trends and make your trades accordingly. So that's one, right? You just have to be in. The second is, of course, oftentimes with derivatives trading, there's something called leveraged margin trading associated.
Yeah.
So this is very, very risky. It's a high risk reward play, but also you can lose a lot of money if you make the wrong decision because you're essentially borrowing funds to make trades.
Yes.
Yeah,
Yeah. This is what they say when you got liquidated.
exactly. So with leverage, you'll often hear or see like 10x, 50x, 100x. 100x is quite crazy and really risky
Mm-hmm.
because imagine if with 100x leverage, it means, for example, if you borrow like say if you start with $1,000 of your own funds,
Right.
you could essentially trade with an equivalent value of say 100,000.
Right.
Yeah, 100x of what you have. So if the market moves by like 1%, that 1% is amplified by 100x as well.
So, but
Yeah.
let's say, okay, so you're borrowing against what? It's I guess fractional. It would be sort of like fractional loan against what you have, right?
Yeah, so usually where do these funds come from? Well, if you're trading on a big centralized exchange, these exchanges either have the funds themselves to lend you,
Yeah.
or there's other, I would say, traders on the platform to lend you money, which is a whole nother business to do.
What if I don't have it?
If you don't have what?
Yeah, let's say I've leveraged against myself, right? Leveraged it against the $1,000 that I have, and I called it wrong. So, who are they going to come knocking on my door?
Yeah, so I mean, usually to even open that trade, you need a minimum amount, say $1,000.
Right.
Now imagine the market dips,
Yeah.
and then the value of your account or your trade goes below 1,000
Yes.
or whatever amount, right? Is specified.
Yes.
Yeah, you're gonna get the big scary word called liquidated.
Yes.
Yeah, yeah,
So they just take your money.
yeah. So
They can't take more than what you have, obviously.
they'll force you out of your positions.
Okay.
Yeah.
Right. Because you heard about that one guy, right? That he was trading live on Twitch, actually. I think he was trading live on Twitch.
Yeah.
And he was doing 100Xs, man. He was,
Yeah, yeah, man. Be careful with that, man. 100x.
I was like, everyone's just laughing because this guy's clearly just completely lost it all.
Yeah.
Yeah, no, it's okay. So look, that's on the micro scale. So on sort of on a personal level. So like buyer beware, caveat emptor. Look, you can't just really luck your way into a really good. Well, I suppose you can, but it's pretty dangerous. Now that's on a sort of like obviously mitigating your risk, right? Now, what about on a macro? Sort of kind of using that again, that toxic asset, sort of GFC crisis. Is that possible? I feel like it is possible, but let's maybe just play with that scenario for a little bit. Like what is potentially a negative narrative around derivatives, or at least potentially around crypto derivatives?
Right. From a macro perspective, yeah. The thing is, if another, say, 2008 crisis happens where everyone's taking super risky loans
Yes.
and the banks or whatever assets backing it up was supposed to be there, but it really wasn't. Yeah, things then you start having a domino effect of a crash. With the crypto derivatives, these at least on a decentralized platform, these would be based on smart contracts that would do the liquidations for you.
Right.
So in a worst case scenario, right, imagine there's a huge sell-off. You'll see a chain reaction of these smart contracts just selling off, liquidating at every single level. So theoretically, it would return back the original money that's backing whatever that trade is or derivative. Theoretically, right?
Right.
Yeah.
Because you couldn't put you couldn't put a greater amount if it wasn't actually equal to that, at least to that amount.
Yeah, and then there's no better than a smart contract to actually verify that with math, and you don't need, you know, some greedy bank or trading institution to check that for you.
Right. Well, because
Yeah.
I mean, a lot of those assets were actually hidden. They were bundled and hidden, right?
Yeah, you know, you can do a lot of accounting tricks to make things look nice,
Yeah.
make things look like they're well collateralized, but in fact, you know, they turn out to be like shady assets, and it became worthless, right? When people when they realize that, okay, we need to sell these or whatever. So,
Okay.
but that's the problem is with derivatives, right? There's also things with like synthetics. So imagine taking like real stocks and then putting that as a tokenized asset.
Yes.
Or if you take like, you know, real estate, the thing is smart contracts are only good as to the point where it's still verifiable. But as soon as you go to the real world, I know there's oracles, but what if those real estate assets, you know, are fraud or whatever?
Yes.
So there's an inherent limit to
Yes.
how much this can go, but I still think it's a better overall solution than what we had previously before blockchain.
Yeah. No. Well, that was actually the whole.
Yeah.
I'm still trying to wrap my head around the whole Oracle thing. I mean, it's clear it's marrying that off-chain, on-chain world. I mean, I get it. Ultimately, that's where we're driving.
Yeah.
But yeah, so I could see where that would be an issue because at some point it could still be falsified, right?
Someone's going to gamify it.
Yeah.
Someone.
Yeah. There's
Yeah.
always going to be a way to figure out a loophole, and I guess that's the whole point. Is it's a sort of cat and mouse with finding these loopholes. So look, I think. On that note, I think we covered quite a gamut. Just going on the topic of derivatives, I think we could certainly go a lot deeper, and I know we plan to over time. But I thought it would be good to go over these topics as it's relevant, you know, and as you know, you and I talk about it on a daily basis, and how it applies to our product, and actually how it applies to, you know, how we communicate to a wider audience, and how we can get people to see the potential of this asset class, you know, which is going to be growing in orders of magnitude. And actually the many products that are already coming out now, you know, they're already starting to come out now. You know, we're talking about cross-chain, that's interoperability. These are, you know, things that were very kind of like outlandish concept just only a few years ago. So they're starting to become real world now.
Yeah, yeah. So here's the thing is, even if they're outlandish concepts today, it's really simple, right? There's going to be an inherent need and demand for this. So it's just only a matter of time before more people realize the value, the need, and then they really build out the infrastructure needed.